Well, I think we should first talk about what the definition of liquidity means to an individual. So liquidity is the ability to exchange an asset for cash. The easier it is to convert the asset, the more liquid it is. This is important, and it's important to have access to your cash because if you're ever presented with an opportunity, whether it be to buy real estate or an investment when it's on sale, then you miss out on the opportunity. And having liquidity doesn't necessarily mean that it's sitting in your checking or savings account earning zero. Some accounts have the ability for you to access your cash through a line of credit or loan feature. Those two features are super cool because typically you don't have to sell the underlying investment in order to access your cash. So not only are you able to take advantage of the new opportunity, but you also continue to earn the same rate of return on your existing investment. There are several different strategies you can use to keep your portfolio liquid. We access a lot of lines of credit, or if you participate in whole life or cash value insurance, you're able to access your dollars at any time just via policy loan. Completely flexible repayment, and you continue to earn the same rate of return on your existing cash value as if you never borrowed the money. Yes, in your portfolio, typically the more liquid you are, typically the less likelihood of earning a higher rate of return. So you can sacrifice some rate of return whenever you have liquidity. By having the line of credit on your portfolio, you continue to keep those assets invested and you continue to earn the same rate of return on those investments even when you have the line of credit outstanding. Many investments are actually very illiquid. I mean, one that comes to mind to me is real estate. With real estate, it's not easy to exchange that asset for cash. You know, if you're in a down market, you wouldn't want to exchange it for cash. You'd want to hold it until the real estate rebounded and sell it for a profit. But there are a lot of assets that aren't always liquid. But if you think about things like treasuries or stocks, mutual funds, typically you can sell out of those and the account settles overnight and you can have access to cash the next day. A lot of clients that come in have a lot of money sitting in a checking or savings account and it's earning zero rate of return. And sometimes I think that they have a comfort level of just knowing that they have access to those dollars on a whim. But the reality is you probably don't need that much sitting in a checking or savings account. If anything, you're upside down with inflation because you're not earning a rate of return on those dollars sitting in your bank. So by helping clients and educating them to teach them to understand how to use things like lines of credit and to teach them that, not every stock portfolio has to be extremely aggressive. We can try to keep up with inflation, well, normal inflation rates, but we can help them invest those dollars and at least keep up with the inflation rate, not just continue to be upside down by leaving too much money sitting in their checking or savings account.